Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Nike Inc., ticker symbol NKE. We're looking at Nike today as a subscriber request. Nike is also owned as a small percentage in Terry Smith's Fundsmith portfolio. It's owned in Markel Asset Management's portfolio by Thomas Gaynor, and Christopher Bloomstrand has a small position in Nike that he recently added to as well. So right now, Nike is trading for $112.85 per share. Over the last year, Nike's stock price is down 33.5%. Over 5 years, however, Nike has compounded at a rate of 12% annually. Over 10 years, they're compounding at a rate of 16% annually. And going back prior to the global financial crisis, over the past nearly 18 years, Nike has compounded at a rate of about 13.5% annually. Keep in mind that Nike also pays out dividends. Currently, they have a 1.2% dividend yield, and their average dividend yield over this time period would be in addition to this compounded annual return. Nike is trading more than $50 below their 52-week high. They're up about $40 from their 52-week low, and Nike is a very large business. They have a $175 billion market cap. For more background about the company, Nike is the largest athletic footwear and apparel brand in the world. It designs, develops, and markets athletic apparel, footwear, equipment, and accessories in 6 major categories: running, basketball, soccer, training, sportswear, and Jordan. Footwear generates about 2/3 of its sales. Nike's brands include Nike, Jordan, and Converse. Nike sells products worldwide and outsources its production to more than 300 factories in over 30 countries. The company was formerly known as Blue Ribbon Sports Inc. and changed its name to Nike Inc. in 1971. Nike was founded in 1964 and is headquartered in Beaverton, Oregon. For our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Nike based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to improve and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 major reasons for this. The first is that the average publicly listed business earns about a 7% return on capital. And the second is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. And these business returns are going to be captured here by return on capital. So by looking for a benchmark of 14% or higher here, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. In all 5 of these years, Nike has earned returns on capital that are above this 14% benchmark we're looking for. They ended their fiscal 2022 earning about 23% returns on capital, and over their last 12 months, they're earning about 20% return on capital. Averaged out over this period, Nike is earning 26% returns on capital, which is a little bit under 4 times better than that of an average business, and almost double that benchmark we were looking for. So this is a very strong check here to start things off on metric number 1. Next up, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenues, net incomes, and free cash flow growth over the last 5 years. And this metric is all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of them is down, this entire metric will be an X. We'll also be including their last 12 months worth of numbers in our calculations here. So over this time, Nike has grown their revenues by about 30%. Their net incomes are up nearly triple over this period, and part of that was because of a $2 billion income tax expense that they had in fiscal 2018. They paid about $700 million in income taxes in 2022. And looking at their free cash flows, probably the most important aspect here, even though they grew their free cash flows from fiscal 2018 until fiscal 2022, from fiscal 2018 over their last 12 months to current day, their free cash flows are down about 8%. This is important because free cash flow is really the lifeblood of any business, and a business's abilities to produce free cash flows now and until Judgment Day is ultimately what that business is going to be worth. So a business can use its free cash flows to reinvest back into the business, buy back shares, pay down debt, make acquisitions, or pay dividends. So it's not great to see that their free cash flows are down over this period, especially when their revenues and their net incomes are up, meaning that this is going to be our first X today coming in on metric number 2. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Nike on a per share basis. So we're looking for earnings per share growth over the last 5 years. As mentioned, their earnings are up nearly triple over this period because of that income tax expense in 2018. In addition to this, Nike has bought back about 3% of their shares outstanding. So that's a small amount of buybacks over this period. It's good that they're not issuing new shares and diluting existing shareholders through something like share-based compensation. So between the growth in their earnings and this slight amount of share buybacks, this is a check here on metric number 3, as Nike has grown their earnings per share over this time. Then next up, metric number 4 is going to be very similar. Here we're looking for free cash flow per share growth over the last 5 years. Again, we learned that their free cash flows are down by about 8% over this time frame, and they've only repurchased about 3% of their shares outstanding. Nike has earned $2.38 worth of free cash flow over their last 12 months, so that's just 4 cents down from where they were in 2018, but that is a decline over this time frame. So this is our second X of the day coming in on metric number 4. So far, to recap where we stand currently, we are split evenly, 2 checks and 2 X's through our first 4 metrics. Then next up, for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. We want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that they produced over the last 5 years. So Nike ended fiscal 2022 sitting on $370 million worth of cash left over after paying off all their debt. Since then, they've increased their net debt position, and right now they have about $715 million worth of net debt. However, over the last 5 years, Nike has produced about $20.5 billion worth of free cash flow. So that's a ton of free cash flow coming into the business. Very easily, Nike's able to support this sub $1 billion total net debt position. And this is a massive check here on metric number 5, as it looks like relative to the debt that they're employing in their business, Nike is very, very cash flow generative. In fact, over their last 12 months, they produced about $3.6 billion worth of free cash flow. So they'd be able to pay off all of their net debt with only about 3 months worth of free cash flow. Currently, it looks like Nike's balance sheet is in a very healthy position. Then the big metric of them all, metric number 6, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this would potentially give us a slight risk premium to the rate of the 10-year treasury yield and potentially give us another reason to be interested in Nike. So we're using their total enterprise value here because it takes into account both their market cap and their net debt position, and it's going to give us a picture of the economic reality of the business that's going to be more similar to as if Nike were a private company. Right now, Nike has a $176 billion total enterprise value, and we learned that over the last 5 years, Nike has produced $20.5 billion worth of free cash flow, meaning that in an average year, Nike is producing about $4.1 billion of free cash flow. So when we divide their $4.1 billion of their average free cash flow by their $176 billion total enterprise value, that gives us an average free cash flow to enterprise value yield of about 2.3%. So that's coming in below the yield of the 10-year treasury and less than half of that 5% mark we're looking for. So on an average basis, this is an X here on metric number 6. Also worth being aware of is that their free cash flows over their last 12 months are down from where they've been historically over the past 5 years. So again, we learned that they produced $3.6 billion worth of free cash flow over their last 12 months. So to get a current free cash flow to enterprise value yield for the business, when we divide their $3.6 billion worth of their last 12 months of free cash flow by their $176 billion total enterprise value, that only gives us about a 2% current free cash flow to enterprise value yield. So on both a current and an average basis, it looks like Nike is not offering us that potential risk premium we'd ideally be seeking here. And so even though metric number 6 is an X, this doesn't mean that you're going to throw out Nike in its entirety. This is just one of our 6 metrics, and even though these select 6 metrics are simple, when combined together, they can be very powerful. Then as a bonus here, we're looking at Nike's dividend profile. Nike's currently paying out a 1.2% dividend yield, so that's slightly below the yield of an S&P 500 ETF right now. In 4 of these 5 years, Nike has comfortably supported their dividend payouts with the cash flows that they've been bringing in. Their fiscal 2020 was their only exception here. Since then, their free cash flows have rebounded, and even though they're down cumulatively over this last 5-year period, Nike is still earning free cash flows that are well above the amount of dividends that they're paying out. It does look like Nike's dividend profile based off the past 5 years here is in decent shape, although one potential concern is that they have been growing their dividend payouts while at the same time their free cash flows have not been increasing over this period. If that's a potential concern for you, then that's something you just want to dig into, and as you research the company in more depth, just pay special attention to. Then everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Nike, which takes us on to using a discounted cash flow model to come to a potential fair value for Nike. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're starting with inputs based off of their average free cash flows over their last 5 years. Then projecting these average free cash flows out based off historical growth assumptions for how the business has been able to grow their free cash flows dating back all the way to 1990. So it's up to you to do your own homework on these historical growth assumptions to determine whether or not these are potentially accurate and applicable going forward to give us a baseline projected estimate for Nike over the next 20 years. So starting with a growth stage over the next 10 years where they grow their free cash flows at a rate of about 10% annually, then assuming a terminal stage for the 10 years out after that where that growth rate falls in half and they're only growing their average free cash flows at a rate of 5% annually. If we add in their tangible book value today and we are seeking a 10% rate of return from the business going forward, then it looks like a fair value for the company is only around $53 per share. So that's less than half of their current stock price. Please take into account a couple of caveats here. One is that this discount rate would be including their dividend payouts. Two is that there are a number of reasons why this might not be potentially accurate. That's really where this deeper level of learning about the business is going to come into play. So using these same historical growth assumptions from today's valuations, it looks like you could only reasonably expect about a 1.5% rate of return going forward from Nike, with the majority of this return being eaten up by their dividend payouts. Please keep in mind that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. In just a minute, we'll talk about a recap for Nike, but first we have to address something. What are some of the qualitative aspects around this business, especially around a potential long or a potential short thesis for the company? So starting with some of the key points around a potential long thesis for the business, number one is Nike's gross margins may expand by a couple dozen basis points per year through automation, e-commerce, and higher prices. Nike is actively shifting sales to differentiated retail in North America to increased full-price sales. Number two, Nike's triple-double strategy of increased innovation, direct-to-consumer sales, and speed may improve margins and share. Membership growth in its digital channel has already exceeded expectations. And number three, Nike has a great opportunity in fast-growing markets such as China. More than 70% of Nike's growth over the next 5 years may come from outside of North America. Then for some of the potential key points around a short thesis of the business. Number one, due to factory disruptions, slow shipping, and weakening sales, Nike has struggled to manage its inventory. Markdowns to clear excess product will temporarily negatively impact margins. Number two, Nike has recently suffered poor results in China as rising nationalism has boosted native brands. Given the nation's rising importance in sportswear, Nike can't afford to lose significant market share. And number three, as a worldwide business, Nike is exposed to global problems like the war in Ukraine, shipping delays, and rising input costs. Nike's long-term results could be affected if these problems persist. Hopefully that offers a balanced perspective around a potential long and a potential short thesis for the business. Now let's get into our recap. So in summary, Nike checks the box on 3 out of 6 of our metrics. They're earning average returns on capital in the mid-20s, so significantly above that of a typical business. Their revenues and net incomes have increased over the last 5 years, but at the same time, their free cash flows have declined slightly. Nike has bought back about 3% of their shares, repurchasing just a small amount over this period. Then Nike uses a very small, very reasonable amount of debt relative to the cash flows that they're bringing into their business. They'd be able to pay off all of their net debt with only 3 months worth of their current free cash flows. However, both on an average and a current basis, comparing their free cash flow to enterprise value yields with the yield of the 10-year treasury, it does not look like Nike is giving us that adequate risk premium that we'd ideally be looking for. Then Nike was able to support their dividend payouts with their free cash flows in 4 of the last 5 years. They've grown their dividend over this time, but again, their free cash flows are down overall. However, they had more than enough cash flow coming in those 4 of 5 years to be able to very comfortably support their dividend payouts. And again, the business is not utilizing very much debt whatsoever. 2020 was rough on the business in terms of their free cash flows, but they have rebounded and they're just slightly down from where they were in fiscal 2018. Then finally, performing a discounted cash flow analysis of Nike. If you've done the work and you believe those historical assumptions, then if you are seeking a potential 10% rate of return from Nike, it looks like a fair value for the business is around $53 per share. So the company last hit that mark back in October of 2017, so more than 5 years ago at this point. Again, there are a number of reasons why that potentially wouldn't be accurate for the business going forward. From today's valuations using those same historical assumptions, it looks like you could only expect about a 1.5% rate of return going forward from Nike. Again, keep in mind that they're paying out a dividend of 1.2% right now, so that would be most of this, and that there are some potential headwinds for the business, especially over the short term, that may be depressing their current free cash flows. It's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Nike. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community written articles on different stocks. but over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. As a value investor, you ultimately want to research a business as if you're going to own 100% of it, and you can truly understand the essence of that business and understand what's important and what's not important for that company going forward. So through this deeper research, you'll ultimately learn more about the qualitative and the quantitative aspects of Nike, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Nike Inc., ticker symbol NKE. Again, we looked at Nike today as a subscriber request, and because it's held by 3 notable value investors, albeit it's a small percentage of their portfolios. If you're interested in learning even more about Nike, I would highly recommend the book Shoe Dog, written by Phil Knight, which was Phil Knight's autobiography/memoir. It's an excellent book, and it'll help you get a better background and more perspective around the company. So if you learned something through this analysis, or if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Nike with me, and have a great day.